What if I told you that for just £100 a month, you could build a future with potentially life-changing passive income? Think of it like a subscription service, but instead of streaming movies, you're subscribing to a more comfortable retirement. It sounds a bit too good to be true, doesn't it? Well, it might be more realistic than you think. Thousands of people across the UK are using this exact strategy to secure their financial future. Now, let's be clear, there are no guarantees in investing. The stock market has its ups and downs, and any journey worth taking will have a few bumps in the road. But it's all about how you navigate them. The real keys to success aren't about being a Wall Street genius. They're about patience and discipline. A balanced portfolio and a commitment to regular monthly contributions have proven to be a powerful combination time and time again. So, what can £100 a month actually do? Let's crunch some numbers. Imagine you invest that £100 every month into a portfolio that delivers an average annual return of 10%. After 25 years, that pot of money could grow to around £147,000. That's a nice sum, but the real magic happens when you make that money work for you through dividends. If you build a portfolio focused on income, you could realistically aim for an average dividend yield of 7%. What does that mean in real terms? Your £147,000 pot would pay you just over £10,000 a year in passive income. Add that to your state pension, and suddenly, the financial pressures of retirement start to ease considerably. So, how do we get there? It's a two-part plan. The first part is the growth phase. Here, the goal is to grow your investment part as quickly as possible by reinvesting all your returns in dividends. This is where the power of compounding really kicks in. The second part is the income phase. As you get closer to retirement, you'll gradually shift your portfolio to focus on high-yield dividend stocks to generate that passive income stream we're aiming for. During the initial growth phase, you'd want to focus on stocks with strong growth potential. Think of companies like Diploma, 3i Group, or Melrose Industries. These FTSE 100 companies have a history of delivering impressive returns over the last decade. Their primary job in your portfolio is to increase its overall value. Then, as you move into phase 2, you'll start rebalancing your portfolio. This means selling some of your growth stocks and buying more high-yield income stocks. Companies like Admiral Group, British American Tobacco, or Primary Health Properties are known for paying out generous dividends to their shareholders. These are the stocks that will generate your cash flow in retirement. Interestingly, some stocks can play a role in both phases. If you buy a dividend stock early on and reinvest those dividends, it essentially acts like a growth stock, accelerating the compounding effect. Let's look at a real-world example to see how this works in practice. Take one of the UK's most popular income shares, Legal & General. Over the past 20 years, its share price alone has risen by about 113%. That's pretty good. But here's the kicker. When you include the dividends it paid out over that time, the total return skyrockets to over 630%. That works out to an annualized return of about 10.45%. This makes a stock like Legal & General a fascinating case study for a passive income portfolio. During the growth phase, you could reinvest its dividends to supercharge your returns. Then, in the income phase, you could start taking its generous 8.8% dividend yield as cash, boosting your overall passive income. Of course, we have to be realistic. All these numbers are based on past performance, and there's no guarantee that any stock will continue to grow or pay dividends forever. Even a solid company like Legal & General isn't without its risks. For instance, recent changes in accounting standards could introduce some volatility to its reported profits, which might make some investors nervous. But despite these complexities, its long-term track record of paying dividends speaks for itself. The key is not to put all your eggs in one basket. By including shares like Legal & General as part of a well-diversified portfolio, you can start building a solid foundation for your financial future. So, let's recap the strategy. You start by consistently investing £100 a month. In the early years, you focus on growth, reinvesting everything to let your money compound and grow. As you near your goal, you gradually shift your focus to high-yield dividend stocks to create a reliable income stream. This isn't a get-rich-quick scheme. It's a long-term plan that requires commitment. But the idea of turning a small, regular investment into a significant source of passive income is a powerful one. It's about taking control of your financial destiny, £100 at a time. It's a journey of 1,000 miles that begins with a single step, and that first step could be setting up your investment plan today. Remember, if you're ever feeling overwhelmed or unsure, it's always a good idea to seek advice from a qualified financial professional. They can help you create a plan that's tailored to your specific goals and circumstances. Your mental and financial well-being are what matter most. The journey to financial freedom is a marathon, not a sprint. With the right strategy, a dose of patience, and the discipline to stick with it, that goal of £10,000 in passive income might be closer than you think. Thanks for watching, and don't forget to like and subscribe for more content to help you on your investment journey.